This is Finextra at Cybos, and today I'm here on the SmartStream stand with Darryl Twiggs. We're talking about the integration of reconciliations and cash management, among other things. Darryl, why is the integration of reconciliations and cash management such a high priority for banks? What's driving the focus?
Well, it's really all about understanding the risk of failure of any transaction with counterparty. Counterparty risk today is at the heart of all operations. Traditionally, cash management looks at the predicted cash balances that the bank is expecting in that day. Our paradigm is slightly different and more unique in that we look at what's predicted and what is actually occurring. So we're looking at the 940s, 950s, the 900, 910 messages coming in throughout the day. But those are all what is the basis of settled. If we move now forward and to consider what's happening in real time, what trades are actually happening this moment, the bank needs to understand what their commitments are. So the only way to actually move forward to understand what real-time cash management is about is to actually look at what trades are being performed, what states they are in terms of their confirmation they're expected to settle. So we're integrating reconciliations and cash management because two things. First of all, it enables us to deliver, in terms of fast time to market, intraday reconciliations using a 942 or other real-time cash messages. We can actually promote those into the cash management balances and give the operations team in the back office a true picture of what their cash balances are and how they move minute by minute. Secondly, often you find banks will buy a cash management solution, they'll buy a reconciliation solution, two solutions. That means two feeds. That means IT support have to deliver two sets of messages, albeit the same, to those two solutions. By combining reconciliations and cash management, we're only asking IT to deliver one set. And as Gartner said, for every dollar you spend on a license, it costs you $10 in support. So we're eliminating the cost of ownership of those solutions and at the same time delivering the most efficient way of understanding the movement of cash balances throughout the day.
Are banks actually being encouraged to monitor intraday liquidity globally?
They're being forced to. The FSA is demanding reporting on an hourly basis. Banks today, certainly within the UK and coming forward in Europe, today they're being asked to actually report on how those Nostro accounts balances are moving. Are they overdrawn or are they long? And they have to explain on an hourly basis what action they're taking to reduce those risks. Okay? So it is very much a matter of being forced by regulatory requirements to do that daily reporting. Now, the only way of really truly understanding those movements, again, is if you have an intraday capability. Okay? That will give you a central point in which you can actually extract that data. Today, banks are having to look at multiple systems to understand where the cash balances were in the beginning of the morning, what trades have been committed, what trades have come in terms of settlement. Okay? With a intraday cash management solution, that data is all in a single repository, so you can automate that actual reporting, rather than having two or three people purely getting and collating that data to produce those reports for the regulatories.
We hear a lot about how bad data is a problem for banks, but how many of them actually know the true cost of this problem?
It is ironic that here we are in Osaka, Japan. This is the heartland of Duran, of Edward Deming, who gave Japanese manufacturing quality management system to make them a centre of excellence for manufacturing. Banking is not in that position today. It's nowhere near. To measure the true cost, okay, you have to understand not only what your day-to-day operational costs are, but what the full cost is. And the banks have only got to look at how much cash they have to hold in reserve against the trades that they are committed to understand that's what the true cost is. Do they focus on trying to measure the individual cost? Well, sometimes they do, in terms of an operational cost, how much cash they may well lose, how much credit they may well have to compensate a counterparty for, but the true cost is capital adequacy, and that is billions. Okay? So the only real way of combating that is to look at having the best data up front as soon as the trade is actually incepted, to ensure that your reference data is correct, that you're enriching that trade correctly so that it will flow down the life cycle of the trade without human intervention. Okay? And that's really where our point of principle is coming from. With our reference data, we're looking at providing the best quality data for the trade as it is incepted. We're enriching those trades with SSI information, legal entity information, ensuring that correct counterparty is to be credited or debited accordingly as soon as that trade is actually incepted, so that it will pass through the reconciliation systems, the payment systems, without human intervention.